This will look at calculating cost of goods sold when using the LIFO method, the last in, first out, but it's going to look at both using a periodic and a perpetual system because it's going to be different. So first, a review. What is the cost of goods sold formula? Most textbooks present it this way: beginning inventory plus purchases. That's going to give you what's on your shelf, what's available. And if you remember, the only two things you can do with your inventory is sell it or not sell it. Then if you subtract what's not sold, you'll come up with cost of goods sold. And of course, looking at a T account method, beginning inventory plus purchases minus ending inventory is going to give you cost of goods sold. Key to remember here, what are the only two things you can do with your inventory? Sell it, and that's your cost of goods sold number, or not sell it, and that's your ending inventory. These numbers will be the same. So looking at an example where you have various purchases and sales, take this in a three-step order. First, determine what's available for sale. Then determine cost of goods sold using LIFO, and whatever's left over, what you haven't assigned to cost of goods sold from what was available, should equal ending inventory. Because remember, ending inventory and cost of goods sold will equal that same number available for sale. So the first part, we're just going to rearrange things. The other list, you had beginning inventory purchases, and then a sale, and then a purchase, and then a sale, and then a purchase. So separate it out so you're not mixing up your numbers. Because if you mix up your numbers, you're going to be assigning a revenue amount, that 35 per unit, but you want to focus on the cost, not the sales price. So what is the cost? And what is an ending inventory if you're using LIFO? With LIFO Perpetual method, you must be very careful to watch the dates. So first, here is your list. You have available for sale 950 units at $22,225. That was your cost for what you paid for it. And if you see those yellow lines, those yellow arrows over on the side, that represents the point of sale. So with the perpetual method, you have to be careful to watch the dates. And here are your sales. You sold 300 units on the 15th and 375 on the 28th. So what cost will you assign to each sale? The key to remember with the perpetual, you cannot assign a cost for something that you have not yet purchased. So at January 15th, what were the last units in? You hadn't bought the ones on the 21st or the 30th yet. So you're going to take your last in as of the point of sale, January 15th, which would be first the 250 units at 22 purchased on the 9th, and then you still have another 50 because you sold 300. So you take 50 out of that 75 purchased on the 1st. And then for your second sale, you're just, again, what is last in as of January 28th? Well, you sold 375, so you're going to take it out of the last in at that point in time, January 21st, out of the 400 purchased at 24. So using this method, LIFO Perpetual, you sold 675 units at a cost of goods sold of $15,500. Now these red lines, you do whatever works for you. You can mark out and just kind of figure out what do you have left, because you have cost of goods sold and then you have to figure out ending inventory. January 1st, you assigned 50 at 20 on January 15th sale, so that leaves you 25 units purchased at 20. And then you have 25 units purchased on the 21st. The ones from the 9th, those were all sold. And then you have all of the purchases from the 30th for a total of 275 units and 6,725 for ending inventory. Now let's take a look at the periodic and how that's going to differ. With the periodic, you are not assigning the cost until the end of the period. So even though the sale occurred on the 15th, what were the last purchases for the period? So in essence, you're assigning a cost of units that were not purchased until the 21st or the 30th. So you're assigning cost on the 15th to units you didn't purchase until a week or two later, which seems very strange, but this is how it's done using the periodic system, and it's how it differs. Again, figure out total cost of goods sold, total ending inventory, and remember what this should equal. It's going to equal available for sale, the original one. So look at the differences with perpetual and periodic. Cost of goods sold, perpetual, $15,500, but periodic, it's higher, $16,325, and ending inventory is lower with the periodic than the perpetual. Key to remember, in a rising market, in a normal inflationary market, LIFO perpetual cost of goods sold is higher than FIFO, but it will be lower than LIFO periodic. In a rising market, LIFO periodic will have the highest cost of goods sold and the lowest ending inventory. With either, the newest items sold first, LIFO cost of goods sold will be different, so watch the dates. With a periodic, again, you wait to record cost of goods sold until the very end of the year, so you could actually assign for a sale in January something you don't even buy until December, 12 months away, if that's your accounting period, if you are using LIFO periodic. With FIFO, perpetual versus periodic, it doesn't matter, perpetual or periodic. It will be identical because you're always going to assign the oldest first.